There's a company trading on NASDAQ right now with a $3 billion market cap. Sounds normal, right? Except it made less money last quarter than a local Subway franchise. We're talking about $384,000 in revenue against a valuation that rivals some actual tech giants. But here's where it gets wild. They just raised $1.5 billion in cash, and insiders are selling into the hype. This is the story of how a quantum computing startup became a lesson in financial engineering gone sideways. Quantum Computing Inc., ticker QUBT, is a small New Jersey-based firm betting everything on photonics, basically using light instead of supercooled atoms to build quantum computers. The promise? Room temperature quantum computing that doesn't need a nuclear cooling system. Sounds revolutionary, but the reality is way messier, and that's exactly what we're unpacking today. Here's the thing. For years, QUBT was just another software company trying to build quantum algorithms. Long sales cycles, dependence on hardware they didn't control. Basically, they were the middlemen nobody wanted to be. So in 2024, management made a bold bet. They'd stop being software guys and start being semiconductor manufacturers. They'd build a thin-film lithium niobate, or TFLN, foundry in Tempe, Arizona. Think of it like this. They saw they were getting crushed in the software game, so they decided to own the entire supply chain. Not just sell the quantum computers, but sell the photonic chips that go inside them. And here's the kicker. Those same chips are critical for AI data centers trying to wire up massive servers faster than ever before. Smart move? Maybe. But it requires billions of dollars. And that's where things get interesting. In late 2024 and early 2025, QUBT went on the most aggressive capital raising spree you've ever seen. November, $40 million. December, $50 million. January, $100 million. Then Q3 2025 hits, and boom, $500 million. And in October, they close a massive $750 million private placement. All in less than a year. Total, $1.6 billion raised. Pretty wild, right? You see where this is going. Now suddenly, QUBT went from this company that was hemorrhaging cash and nearly delisted from NASDAQ to a company with a cash fortress that rivals industry leader IonQ. On paper, the risk profile completely changed. The valley of death, that period where quantum companies usually die before ever proving their technology, got crossed. They literally bought themselves time. But here's the part most people miss. That cash didn't come from nowhere. It came from investors, which means shares. Lots and lots of shares. Then they started raising capital. And raising. And raising. By November 2025, share count exploded to 141 million. That's a 29-fold dilution in less than 15 months. For someone who held the stock before all this, their percentage ownership got absolutely obliterated. To keep the stock price flat, the company would have needed to increase its actual value 29 times over. They didn't. Now here's the red flag. In September 2025, directors were selling shares at $15 to $16 each. Then, in October, the company announces the massive $750 million raise and prices it much lower. The stock then trades down to $10 to $11 by late November. Those insiders? They sold at the peak right before announcing the dilution bomb. That's not confidence. That's a vote of no thanks for the upside from here. So what did they get for all this? Revenue. Sort of. Q3 revenue 2025 was $384,000. Let's think about that number for a second. Annualized, that's about $1.5 million for a $3 billion company. That's a price-to-sales ratio of about 2,000 times. 2,000 times! The company reported net income of $2.4 million that quarter. Sounds great until you read the footnotes. Nearly all of that came from interest income on their massive cash pile and accounting adjustments on warrant liabilities, not from actually selling quantum computers. The core business lost about $10.5 million. But wait, they've got the foundry in Arizona. That's supposed to be the play, right? Converting their quantum technology into classical optical chips for data centers. Well, they announced their first foundry order in November. One order from an Asian research institute. The facility looks more like an advanced laboratory than a commercial production line. And remember, they're burning $10 million a quarter on R&D and operations against less than $400K in revenue. The company loves to mention NASA. They got a $406K contract for space-based LiDAR work. That's real validation. NASA doesn't work with fraud. But here's what people miss. 406K is a rounding error for a $3 billion market cap. It's meaningful for the science, not the business. Their core technology is called entropy quantum computing. Instead of gate-based quantum computers that need near absolute zero cooling, they use room temperature photonics and treat environmental noise as a feature, not a bug. Can it work? Maybe. The physics is interesting, but the quantum computing world is split on whether this is real quantum computing or just a sophisticated classical optimization engine wearing quantum's clothes. Let me be fair. There's an argument here. $1.5 billion in cash is a legitimate floor. At 141 million shares, that's about $10.63 per share in pure cash backing. The stock is around $11, so you're not getting destroyed on the downside right away. If management somehow uses this capital wisely, and that's a big if, they could acquire a revenue-generating business or actually scale the foundry. The POET partnership targeting AI optical engines is a real commercial opportunity in a market projected to hit $12 billion by 2030. And here's the thing. Photonics might actually be the future of quantum computing. If room temperature systems work, supercooled competitors like D-Wave and Rigetti could become obsolete. That's a real moonshot. But the risks dwarf the opportunity. The forensic analysis is brutal. We're looking at a company that's mastered capital markets engineering while failing to build an actual business. The serial dilution, the insiders selling into the hype, the lockup expirations coming on $750 million worth of stock. All of that creates structural headwinds. Short sellers have identified real problems. The foundry might be overstated. The revenue might be inflated through related party deals. The technology might not actually be what they claim. Are those claims 100% true? Doesn't matter. Class action lawsuits are pending. That's a distraction and potential liability. Here's what keeps me up about this. The company is trading at approximately cash value, which means the market is assigning zero value to the business itself. Zero. For all the talk about quantum revolution and photonic dominance, investors are saying, we'll pay for the cash, but the business, that's worth nothing. The upside only works if they're right about both the technology and the commercialization. The downside works if they're wrong on either one, or if they burn through the cash on bad acquisitions. Watch for these. First, can they actually ship TFLN chips in volume from Tempe? Not one research order, volume. Second, does the POET partnership deliver a working 3.2 Tbps optical engine prototype? Third, does cloud access revenue grow? Right now, it's basically non-existent. And fourth, does at least one of those lawsuits settle or get dismissed? If all four happen, maybe the story changes. If none of them do, you're holding a pile of cash with no business underneath it, and that cash eventually gets spent. So here's what QUBT actually is. It's a venture capital-style call option on photonic quantum computing, protected at a cash floor, but absolutely buried in dilution. It's a company that mastered the art of raising capital while completely failing to generate revenue. It's a bet that insiders sold into because they saw the dilution coming. Is there a chance this works? Yeah, maybe they really do build the next generation of quantum computers. Maybe the TFLN foundry becomes a multi-billion-dollar business serving AI data centers. Maybe room temperature photonics solves everything. But the current valuation prices in a ton of that success, while the actual business execution is almost non-existent. You're not investing in a quantum computing company. You're investing in a hedge fund that happens to have a quantum division, trading at a premium with a history of wiping out early shareholders through dilution. The real tell? The founders sold at $15. You're thinking about buying at $11. That's not a vote of confidence. That's a heads up. So yeah, while everyone's chasing the big AI names and the obvious quantum plays, QUBT is the overlooked underdog. But overlooked and undervalued are two very different things, and QUBT is starting to look like the former, not the latter. And hey, I hope this helps you on your quest for profits. Catch you on the next one.